Thank you so much for this opportunity tonight. We are representing Fordham University, and we are very excited to talk to you about Microsoft. When evaluating Microsoft, we believe that their vertical integration has positioned them in a new era of growth in a rapidly changing IT ecosystem. We looked at not only the strengths of their over 360 individual products, but more importantly, how the compatibility and integration allows Microsoft to drive value to the users of today as well as tomorrow. We are recommending a strong buy with a street-high target price of $42. Microsoft is in strong financial health with attractive dividends, has steady revenue income, and tremendous growth opportunity. Our analysis indicates that Microsoft has strategically positioned itself to capture the growth in the shift towards businesses adopting a mobile-centric IT infrastructure. The catalyst for our stock price are the adoption of Windows Mobile Platform as well as enterprises going mobile. Microsoft has moved into new markets before with great successes as well as lessons learned. First three are where they use a core competency to gain a dominant market position. Now, they gained a harsh lesson with Zune in that they do not have the competitive advantage in media and entertainment software for consumers. They are not making the same mistake with their 2013 mobile initiatives, as they have the strongest competitive advantage in business applications for businesses going mobile. Microsoft is all in on their existing products as well as new product rollouts. As such, we are too with the $42 price target. Now I'll hand it over to Jonathan for a market analysis.
Thank you, Paul. Now there are three key takeaways from our market analysis. The first is that Microsoft is embedded in businesses around the world. From operating systems to servers to software, there's hardly a company that hasn't felt the network effects of Microsoft. The second point is that the cloud is driving mobile business. What this means is that IT managers need to find ways to securely incorporate devices into their IT ecosystems that are compatible with their legacy software. The third point is that Microsoft's core competencies, accompanied with the vertical integration model, are going to launch them into a new era of growth. Now, we spent 40 hours interviewing IT professionals, and what we learned is that compatibility, integration, and security are the key drivers of IT expenditure. We also learned that Microsoft Office serves more than just a productivity function in the business world. It also works hand in hand with enterprise applications from SAP, IBM, Salesforce, and Oracle. Now, this $156 billion enterprise application market, working hand in hand with the 1 billion Microsoft Office users around the world, allows Microsoft to leverage strong competitive advantages in businesses everywhere. Now, we mentioned the paradigm shift in IT expenditure. One very important aspect of that shift is businesses going mobile. We believe that the tablet market will reach 400 million units in the next 5 years, that businesses will make up 30 to 35% of that market, and that Microsoft will maintain a 17% market share. Now, that 17% market share is a reflection of CIOs currently adopting the Windows Mobile Platform at a very high rate in the corporation, as well as our proprietary survey of over 400 survey respondents indicating that people will be more inclined to purchase a tablet if it served a better business function. Now, that 17% market share will generate $46 billion in revenue in 2017. Now, we mentioned vertical integration before. Vertical integration, in simple terms, is hardware and software working together to make a user more efficient. I'll tell you a case study quickly about a tech company employing a vertical integration model to create and capture a new market. Apple, in 2004, created the music device market. As you can see here, they've been employing this competitive position over the last 8 years, and this growth has been sustainable. We believe that this is exactly what Microsoft is going to do. We calculate incremental lift in their core businesses and supplemental lift in their devices. We've analyzed all of Microsoft's strongest competitors and learned that no competitor can match the suite of enterprise solutions on a tablet that Microsoft can. As such, it's only a matter of time before the street recognizes this growth opportunity. I will now pass to Ken. He will support this through our FSA.
Thank you, John. For our financial statement analysis, we built a bottom-up financial model product by product and projected out the full 3 financial statements, a debt schedule, and free cash flow forecast. We find that there are 4 key takeaways that differentiate us from the rest of the street and drives our $42 price target. First, we are just scratching the surface when we talk about the incremental lift that tablet sales will bring to Microsoft's ever-growing core revenue base. We model a CAGR of 140% over the next 5 years, well above consensus CAGR of 70%, and driven specifically 3 to 5 years out due to the delayed corporate adoption in the Windows upgrade cycle, as well as the move to the public cloud. Tablets are going to bring for Microsoft an incremental EPS of 5 cents in 2013 and 2014 and 30 cents in 2015. Next, we argue that not only is Microsoft attractive from a growth perspective, as John and Paul just laid out, it's also attractive from a valuation perspective. Today's market price implies negative free cash flow growth into perpetuity, even though over the most recent 6 years, free cash flow growth has averaged almost 18%. In our two-stage free cash flow model, even when we use our most bearish scenario and assume that free cash flow never grows again after 2017, we still calculate an intrinsic value higher than today's market price. And if Microsoft can manage to even just match the long-term growth rate of the global economy in its free cash flow growth, we calculate this stock to be a double at $55. Next, we argue that given their size, Microsoft can and is leveraging up in order to grow faster moving forward. They're going to do this by increasing their debt and paying down their equity. IBM did this in the late 90s, and they have consistently achieved high single-digit to low double-digit growth rates over this time period. Fortunately for Microsoft, they're a solidly AAA rated company, and we think they can take $22 billion more in debt and maintain their AAA rating. If Microsoft issued $22 billion and immediately repurchased shares at today's prices, fiscal 13 EPS would jump 30 cents. In addition, shifting the capital structure from 5% debt to total capital to 30% debt to total capital can lower WACC by up to 340 basis points. Finally, buybacks. The street is well aware of Microsoft's ability to be defensive, highlighted by the $63 billion in cash they hold. However, we don't think the street's giving them enough credit for taking the offensive, which it will most certainly do in the form of share buybacks. The street is underestimating buybacks in our view, only modeling in about $2.5 billion per year. We model $8.5 billion this year alone, which is still conservative by historical standards, yet drives an incremental 10 cents versus consensus in EPS for this year. In other words, of the 22 cents that we're above the street for this year, about half of that's due to buybacks alone. In summary, the move into the lucrative tablet market and the flexibility to ramp up leverage and buybacks is going to allow Microsoft to perform like a growth stock moving forward. And with the dividend yield currently offering more than the 10-year Treasury, investors are paid to wait and get the growth for free. I'm going to now hand it over to Elaine to cover valuation.
Thank you, Ken. Now we are going to introduce about our valuation model. Our target price, $42, is based on our DCF model. We also use the two other relative methods, price to sales and price to EPS multiply, and get results in line with that from DCF. So let's first talk about our primary method, DCF. We use 3 case scenarios here, and each one deals with different market performance assumptions, including the market share and some important ratios, such as COGS, SG&A. In calculation, we first forecast revenue for the next 5 years. Based on assumption, we build division by division. And second, we calculate our terminal value using a perpetual growth rate, using a range between 0 and 2%. Finally, we decide our discount factor, the WACC, by combining the cost of debt and equity. Actually, our assumptions are very moderate. For example, we assume that the market share of Windows division will slightly decline, with other divisions stable. We also choose 1% in our sensitivity analysis, and in this way, we get a price to be $42. Our second method is price to sales multiply. Before that, let's first see some comparables with industry. From the graph, you can see that Microsoft is even below the average in some segments. But based on their performance and their future potential, it is totally undervalued. So, what if we at least choose the industry media level in the industry? In this way, we multiply the industry media price to sales ratio to the forecasted sales, and then sum by part. We get a price to be $43. Our third method is PE multiply. We build a regression model between the PE ratio and ROE ratio. Since from the graph, you can see that there is a strong connection between the evolution of these two ratios. So we figure out a formula and then input our variable, ROE, into it. We get a price to be $49. However, we still base our target price on DCF model because first, we build thorough assumptions, division by division. And second, cash is king. Now I will hand it back to Paul to talk about our risk.
Thank you, Elaine. We recognize 3 primary risks to our price target: disruptive technology, breach of cloud security, and limited product adoption in the near term. We quantify these risks not only through our bear case scenario, but also through a Monte Carlo simulation as well as value-at risk analysis. To reiterate, Microsoft is all in on these initiatives. and we are recommending a strong buy with $42 price target. Thank you so much for your time, and this concludes our presentation. We'd like to open up for Q&A.